Hey everyone, welcome back. Paper LBO, leverage buyout modeling is one of the most popular private equity interview question. It tests the core mechanics of an LBO, but it is super easy to administer and hence interviewers prefer this to test candidates. In this video, I will show you the typical format of paper LBO, solve a real paper LBO for a company in 4 steps, and share a few brownie tips I have picked up from interviews. Let's start with the basics. So what's exactly is an LBO? In simple terms, it's when you buy a target company using a mix of debt and equity. The company then generates free cash flow that pays interest and reduces debt. If EBITDA grows and debt falls over time, your equity value compounds. And that's the magic of leverage.
Let's make this even simpler. Think of it like buying a house. Your enterprise value is the house price. You fund it partly with a mortgage, which is debt, and partly with a down payment, which is your equity. And over time, your salary, which in an LBO is free cash flow, pays down your mortgage and your mortgage reduces. And when you sell the house after a few years, your equity is just a sell price minus remaining mortgage. And that's exactly what happens in an LBO. A private equity firm buys a company using debt and equity and use the company's cash flow to pay off debt during the holding period, usually 5 to 7 years. And when they exit, the final equity value they get is their return. Now let's look at the 4-step playbook we follow for LBO model. Step 1 is to calculate the purchase price or the transaction price, how much we are paying to buy the company. Step 2, sources and uses, how the purchase is financed, how much comes from debt and how much comes from equity. You have figured out the purchase price, but now how are you financing it? How much is debt and how much is equity? Step 3, forecast the company financials starting from revenue to free cash flow. Step 4, exit and returns. So you will find out exit enterprise value, then you will subtract exit debt, and then you will get exit equity value. And then we will calculate the IRR, the return that private equity got. So if you have seen my DCF interview question video, you will notice a similar structured approach. 4 steps, clean, logical and repeatable. If you haven't watched it, I will drop the link in the description below. You can watch it. And before we start calculating, let me tell you what typical format of paper LBO looks like in an interview. So paper LBOs are usually given with a holding period of 3 to 5 years and nice round numbers that make the math simple. Sometimes you will get your question prompt on a printed paper, or sometimes the interviewer will just say it out loud and expect you to do quick math on the spot. So it's really more about your logic and speed than building a full model. So here is the prompt for company ABC, and all numbers are in $million, rounded to whole numbers. You have been given, you are evaluating a leverage buyout for a company ABC. The assumptions have been given to you. Perform a paper LBO and estimate investor return. So you are given purchase price as 10x LTM EBITDA. You are given initial leverage of 6x. Revenue in 2024 was $100, which is expected to grow at 10% per year for 5 years. EBITDA margin is given 50% across 5 years. D&A, depreciation and amortization, 5% of revenue, and capex, 5% of revenue. You have been given no change in net working capital across 5 years. Tax rate 25% constant throughout. Cash interest rate 10%. And you have been told that there is no principal repaid during the holding period. It's only paid at exit from cumulative free cash flow. And then assume exit after 5 years at 10x LTM EBITDA, which is same as your entry multiple. So here there is no multiple expansion which has been assumed. When I say multiple expansion, so if for example entry was at 10, you were asked to do exit at 12 LTM EBITDA, so that's called a multiple expansion. If you want to try it yourself first, pause here and then come back. Now a quick tip here before we start solving. Always ask your interviewer upfront, would you like me to talk through my steps or work quietly and summarize at the end? If they say talk, just narrate your assumptions and key steps and not every single number. And if they say quiet, So stay focused, calculate everything, and then summarize cleanly at the end. Alright, step 1, let's figure out the purchase price or the transaction price. So we have been given a LTM multiple of 10x. LTM stands for last 12 months. We have been given EBITDA margin of 50% and we have been given revenue in 2024 was 100 million. So our EBITDA is 50 million. We have been given 10x multiple to find out EV. So our enterprise value will be 500. So that's our total transaction value, or in simple terms, the price we are paying to acquire the company. Next step, let's see how we are financing the deal and where the money is going. So the company is leveraged at 6x LTM EBITDA, which was given. That means the debt used in this transaction is 6 into 50, which is 300 million. Now, since our total purchase price is 500, the remaining portion, which is 500 minus 300, is 200. That's our equity investment. So, in short, our sources are from debt as 300, equity 200, and our uses is for the purchase price, which is 500. And quick note here, in most paper LBOs, we ignore transaction fees and purchase adjustment unless the interviewer specifically asks, because it keeps the math simple and clean. Now comes the fun part, forecasting and calculating free cash flow. This step might look heavy, but if you stay structured, it's actually quite simple. Here is what we will do. We will project our revenue for 5 years and then apply the given margins to calculate EBITDA, deduct D&A to calculate EBIT, then subtract our interest to calculate EBT, then tax to find out net income, and then again adjust for D&A, capex and change in net working capital to find out the cash flow. So let's go step by step. Our revenue grows by 10% each year. So we start from 100. So in 2024 it was 100. So if we grow it by 10%, it's 110, 120, 130, 145 and 160. If you notice, I have taken a round figure numbers to make my calculation easier. So instead of taking 121 or 133, I have rounded it off to 120 and 130, and that's totally acceptable when you are given just 15 minutes to solve a LBO model. Now, EBITDA margin of 50%. Half of 110 gives us 55, 120, 60. Similarly for the other 3 years. Then again, D&A is given as 5% of revenue, which for a rough calculation, I have taken 5 for this year, 5 for this year, 5 for this year, and then 10, 10. Instead of taking 8 as a number here or 10, 7 as a number here, that's a quick, simple round off that you can do, 5, 5, 5, 10, 10. And then you calculate your EBIT, which is 50, 55, 60, 65, 70. Then interest expense. So your interest expense will be constant across 5 years because you are not paying your debt off and you have been given a fixed interest rate of 10% each year. So 10% of your debt, which was 300 million, that is 30. So 30 all across 5 years, and if you subtract, you will get EBT. Then taxes. So taxes, again, you are given taxes as 25%. So if you apply 25% to 20, that will be 5. Again, if you notice, I have done some round off, which is totally acceptable. So 15, 20, 23, 27 and 30. Now, to find out free cash flow, you have to adjust for D&A and capex. And if you notice, you were given D&A as 5% in revenue and capital expenditure also as 5% revenue. So they both cancel out each other. This is plus D&A and this is minus capital expenditure. So they are cancelling out each other. Then change in net working capital, which was 0 because there was no net working capital in the assumption. So your net income is ultimately your cash flow. So 15, 20, 23, 27 and 30. And if you sum all this free cash flows, you will get a cumulative cash flow of 150. And that's the forecast. Final step. Let's calculate the exit and see what returns we are making. We started with the initial debt of 300 million and generated a cumulative cash flow of 150 over 5 years. So our ending debt, because we have been told that you have to pay off your debt using the cumulative cash flow, your ending debt would be 185, which is 300 minus 150, 185. Our exit multiple is given as 10x LTM EBITDA and our EBITDA in 5th year, which was, our EBITDA in 5th year was 80. So let's see. EBITDA 80, we have been given EV EBITDA of 10x. So if we multiply, we will get 800, and our exit debt after paying off was 185. So our equity value will be EV minus debt, which will be 615. So our EV was 800 minus 185, equity value is 615. Now let's calculate a MOIC number, which is known as multiple on invested capital. So it's nothing but what is your exit equity value divided by initial equity value. Your exit equity value 650, and in your initial equity value, which you remember, it's 200. So you get 3.1x. This is also known as multiple on money. Now let's estimate the IRR using the famous rules of 72, 114 and 144. Rule of 72 tells you how many years your money takes to double at a given compound rate. And you can flip it to estimate the IRR if money doubles in a set number of years. So example, if money doubles in 5 years, so 72 by 5, so 14%. So if you put your money in a fund which has a return of 14% annually, your money will double in 5 years. Second, in how many years will money double at 20% interest rate? So here you have been given an interest rate, now you have to find out in how many years your money will double. So again, 72 by 20, you will get 3.6 years. So that means in 3.6 years, your money will be doubled. Similarly, the rule of 114 and 144 tell you how many years your money will triple and quadruple. So 114 tells you 3x and 144 tells you 4x. So let's go back to our return analysis. Our MOIC is about 3.1x. If we apply rule of 114, given here our money is getting 3x in 5 years, 114 will give us 23, which is 23% IRR. And that's a good return. Generally, top quartile P's target for above 18% return, and it's 23%. And that's it. No calculator needed, all done with pen and paper. So to recap, 4 steps. First one is to calculate purchase price. Second, to figure out sources and uses. Third, forecast to free cash flows. And fourth, to do exit and return analysis. And that's how you solve a paper LBO cleanly under 10 minutes.
If this walkthrough helped, make sure to hit like and subscribe. I have pinned a one-pager answer key and a blank worksheet so you can practice the same question on your own. Try timing yourself for 10 minutes to create actual interview pressure. And remember to round off your numbers to a multiple of 5 or 10 to keep your math simple.